Good morning, ladies and gentlemen. Well, what an absolute disaster. The risk dial was absolutely correct, and we are heading even lower. That's all that one can say. A deal on much lower tariffs than the ones imposed at the moment is the only hope that this market will correct. But I wouldn't hold my breath because I think that Trump means it. He really does want very high tariffs. And that means that the US economy is almost guaranteed to go into a short-term recession. So let's examine what asset prices are doing and why, and where we might end up in the next week or so. This is a chart of real yields, and they have come down a little, but they've come down a lot less than nominals. And personally, I don't think real yields are going to come down a hell of a lot. They are going to come down because recession forces them lower, but the problem is term premium. I think term premium is going to remain elevated, which means that the yield curve is also going to remain steep. And what is the reason for that? Well, let's examine what Powell said on Friday. He said that this is an unprecedented period, that he is as uncertain as he has ever been. In fact, he's more uncertain than he has ever been. And therefore, you have a combination of tariffs elevating the price level, a once-off elevation of the price level, and the possibility of recession at the same time. I think recession will win eventually and prices will come down after that one-off move upwards, but that is in the medium term. And therefore, what he is effectively saying is that when he has the data that confirms whatever it confirms, he will be behind the curve. He will be behind by a lot. So what do I think the likeliest moves are? I think that a 25 basis point move from the Fed eventually is the least likely outcome. Because if the economy goes into recession and he gets the data confirming that it's going into recession, he is going to be miles behind the curve. And he acknowledges that he will be behind the curve. Whatever happens, he will be behind the curve. So if he needs to hike rates because the economy is not going into recession by some miracle, but inflation is ripping, then he will be behind the curve by 50, 75, 100 basis points to the upside. And on the other hand, which is the more likely outcome, if we do have recession, he will not cut by 25. He will cut by 50s or 75s or even 100s. So to me, 25 basis point moves are now out of the window. When the Fed does cut, and I believe they will cut by 50 plus. This is a chart of the SOFR September 2025 against September 2026. And you can see where it is, 50 basis points of differential, that they are discounting that 2026 will be lower than 2025. I just can't see 2026 being lower than 2025. I think the Fed is going to cut by 100 basis points, 150 basis points, 200 basis points, and basically take short-term Fed funds right on top of wherever inflation is. So he's going to have zero real rates for the very short end. And what does that imply? That implies that the whole curve goes positive and we go back up here or even higher. I think that this is the cheapest insurance play that you can have. You are long of the very short end of the curve that is really implying that the Fed is going to make a small adjustment in 2025. If recession hits, it hits now. It hits within the next 2 or 3 months. It doesn't hit in 2026. The data will fall off a cliff, and the Fed will then decide that they have to cut. And they won't cut 25s. They will cut 50 pluses. And the 2026s are already discounting that you will have how much? I mean, they're trading at something like 96.80. So they're already discounting a lot compared to what the 2025s are discounting. And therefore, you have to look for this spread to come in towards zero or even go positive. It's the only thing that makes sense to me. As to the bond curve, the opposite should happen. You should have 2s 10s steepening. You should have 2s 30s steepening even more, and they are. But Fed funds are going to be very low. So Fed funds are going to be 275, let's say, in 6 months, if there is a recession. So if they're 275, you have a positive curve throughout the SOFR and throughout the bond market. I just can't see the bond market having a positive curve and SOFR not having a positive curve whenever we get to that terminal rate. The terminal rate of Fed funds cannot be anywhere near here if we hit recession, and therefore the whole curve needs to be very steep. It's the only thing that makes sense because, let's face it, however much Besson talks about getting 10 years lower, and he's got the 10 years lower, what is going to happen to the budget deficit once recession hits? Well, it's going to go higher. And therefore, the curve will be quite positive because I just can't see who is going to buy all these bonds that he's going to have to issue in any case and refund. And then on top of that, the budget deficit goes up, not down, because of the recession. And they have much lower intakes while their expenditure remains high. Unless he's going to really slash expenditure at the government level, the curve has to go even more positive. And the only thing that makes sense is something like, I don't know, 270 for Fed funds, 350, 375 for 10s, and 4 for the 30-year. So you're looking at a very, very positive curve of at least 130, 150 points between Fed funds and 30s. And if that is the case, you want to continue to look for places to steepen the curve, and you want to stay in the 2s to 5s year area rather than in the long end. The yield curve did very, very little last week because it's finding it very difficult to steepen at the moment because this is a panic, right? People are not thinking about the yield curve, they're thinking about their asset allocations and they're moving stuff. And if you're selling equities, you're not going to buy 2 years, you're probably going to buy 10s or 30s. And therefore the yield curve is doing all sorts of illogical things at the moment. And, you know, we are quite oversold at these levels, 2s, 10s. But there is absolutely no logic in anything but a steeper curve. So you have to take advantage of irrational moves over the course of the next few weeks that probably flatten the curve slightly to put on steepeners. The curve will steepen, and it will steepen a lot. I would guess that 2s, 10s, if we go for recession, are going to be somewhere down here. They're going to be at, you know, over 100. So you have to look through what is happening at the moment and just look for levels at which to put on steepeners. The curve will go much, much, much steeper than it is at the moment. simply because, and I'll reiterate, the budget deficit will go higher in a recession, not lower. Who is going to fund the budget deficit? Foreigners aren't. So I'm looking for moves that eventually take the 2s, 10s all the way down to this kind of area, i.e., 100 plus in terms of steepness. To me, that is the only thing that makes sense. A steep curve all the way from Fed funds, which are at zero real. So whatever CPI is, that's where Fed funds are, and possibly even lower. And then you have a positive curve. I expect exactly the same thing in Europe. You have to look through the current stupidity in the markets. Europe is reflating and will continue to do so, which basically means the yield curve will go steeper. And here you have the 2s. You can see that once it starts breaking that 191 level, yes, that we absolutely caught to the tick just about, where does it go? It goes to 118. Now that is a big move. This is the kind of thing you're going to see. You will see a big move in the short end and a much smaller move at the long end. So 2s, 10s, we could stay in this range for a few weeks, but eventually where do we go? Eventually we go down here. We go down to minus 180. So that's another 100 basis points. To me, that is the only thing that makes sense. You look for levels to put on steepeners, and the level to put on steepener here is minus 53, minus 54. It's going to take a while. This is an irrational period. And the good thing is that after irrationality comes rationality. The only thing is, how long does the irrationality takes place? And don't look to be very precise, because things are going to go wild. A lot of people and a lot of fund managers need to rejig completely their asset allocation, probably including myself. And you don't do that at precise levels. You just hit a bid or lift an offer. That is what they're going to be doing for the next few weeks, because the world has changed. They completely need to rejig their asset allocation, and it's going to take a while, and prices might not make a lot of sense. And this is the time to actually start taking advantage of that, because the yield curves have to steepen. This is 10s, 10s. Think about it. Which country has room to fiscally stimulate their economy? Well, it's not the US. The US has no fiscal room whatsoever. It's running a huge deficit. It cannot increase it. In fact, it wants to decrease it, right? While Germany, on the other hand, has a much smaller deficit and is reflating, and probably will need to reflate more. To me, this spread eventually goes back down towards 100. That is all I've got to say, because I'm convinced I'm right. The dollar is a bit of a conundrum, but not really. I think that it got very, very oversold, and people will continue to sell it at levels. I think every time it goes back towards 104 to 104.90, it's a sell, and I'll be buying puts every time I see it up there. What do I think is likely to happen? I think that we are likely to have a period like this one, in which it slowly, week by week, and we're talking about months now, goes down towards par and just below par, and waits there for the data. And then once the data comes in and we know there is a recession, and we know that all sorts of bad things are going to happen in the US, then it starts breaking the par level. But it's going to take weeks, I believe. And the reason behind that is because things are really not going to go that far. Let's have a look at the individual currencies. So this is the euro, and you can see it keeps on failing at this 110.60 level. I think until you start getting closes above 110.60 on a daily basis, it's not going to go anywhere. It's going to remain in this sort of 108.50 to 111 range for quite some time and then break it. And especially if you start looking at the yen. To me, the yen is going to eventually break down, but only down to 140.60 and then bounce. So you're looking for percentage points, you're not looking for huge moves. Finally, the 200-day moving average is turning, and I think that every time you see it up towards 148, 148.50, 148.80, it's a sell. You buy puts, and I think eventually you cover everything you have around the 140.60. It's going to take time, it's going to take many days, but it's the direction of travel. Euro yen, still, I think the direction of travel is still down towards these 158 area. I don't think that this is going to break for quite some time, and that tells me that, okay, euro yen can come down a few percentage points, which gives you the yen at 141 that I'm looking for, but also says that the euro doesn't go much higher than 111 or something like that for the time being. And therefore that is gives you triangulates rather with the DXY, maybe doing a little bit better short term, but eventually coming down towards the 100 level, and therefore it's quite a tight range for DXY. Well, if we are to have recession, why buy commodities? And that's precisely what GSG did last week. We went from, tick 2293 all the way down tick 2070. These lines, I don't change them, I don't ever change them, and this is what you have. Now, what do I think is going to happen? It's probably going to remain in the 2070 to 2180 range for a bit, and then it's very suddenly it's going to go down to 1975, and I think probably that is when you buy the commodities, because I don't think that the recession is going to be dreadful in the world. We will continue to muddle along without the US kind of thing, but that is the kind of longer term thing that I can see now. Why buy commodities right now? Not when the world anticipates this bad data. You wait for them to come down towards these kinds of levels where they traded before in the so in the 19s. From there on, the risk reward is quite good. Now, if you see a rally, what's it going to be? It's going to be a 2-3% rally in oil because of technical factors, and that'll dissipate and then it'll come back down. I just see no point in buying this until it starts breaking higher. Hasn't done so for many years. Why would you buy it now? What is the rationale for it now as opposed to at any other time since 2022? I just can't see it. Leave it alone until you see a really good level. And the really good level is probably down here in the 18s, right? I mean, that's really cheap. 1977 is cheap, but this is really cheap. Don't forget that in these situations, people throw out the baby with the bathwater. They have to hit bids wherever they are. Volatility is extremely high, and therefore this kind of move is not out of the question eventually, right? So when the data hits and shows recession, where are commodities going to be? I don't see them higher. So gold was down last week together with just about every other asset apart from bonds, and that makes sense because if you think that you're going to have a recession at some stage, why not buy gold over tip, right? You get real rate of return and you get a return. So it makes sense. This is a weekly chart, and we basically had a weekly reversal in gold over tip, gold over STIP, gold over IEF, gold over TLT. You know, it just does make sense that why would you have gold at the moment if you can have bonds and a real return? To me, gold over tip makes far more sense at the moment. You can see what a monstrous move it's had in the past couple of years. In fact, this is all the way to 2020. So the last 5 years, it's nearly, sort of appreciated by 60–70% on the spread. Why not look for it to come back? I can't, I just can't buy gold. I much rather have something like tip. So, in times like these, where fundamentals are changing, you have to have a look at really long-term charts and zoom out. Where does the US market normally bottom out in terms of Blue Angels, i.e. in terms of multiples? Now, this line of expected earnings is going to start turning over probably quite a bit. As I said last week, I don't think there is a single CFO that is not going to take this opportunity to lower earnings estimates and throw the kitchen sink of bad data and news at his balance sheet so he can outperform when? Much later on, i.e. Q3, Q4, maybe Q1 2026. So at the moment, he's going to throw in the kitchen sink of bad news at his balance sheet and his expectations. And therefore, these lines are going to turn over. Normally, as you can see, it always is the case, you go down to the times 16 line and bounce around it and then might go lower and go sideways. But what you're not going to do is going to have another bounce up to the 20 line at the moment. You're much more likely to come down to the times 16, and that is like 4,600, 4,500. That is the bottom, the cheap level at the moment for the S&P. Everything else is still not cheap. Why would you buy it ahead of a recession, right? I mean, unless you think that the economy is going to roar with 30% tariffs. It's not going to happen. So let's zoom out as much as possible and have a look at a monthly chart. And what do we get? Well, this is the previous close, 47.64, and this is the 200-month moving average. I would have thought that it's almost a given that we go down to it. Monthly is all you can look at the moment. 47.64 seems to be the first support level that I can see. Why would we rally? I don't think we can. I think anything around the 52.50 area, if you ever see it, you buy puts. I mean, what else can you do? This is fundamental. This is something that nobody's ever seen before. This is something that comes around once in a lifetime, and we're lucky enough to see it. Get short, buy puts. Weekly chart, 200-week moving average, always has a very good bounce from it, as it were. Where is it? Right here. Right, so what is that? 46.90. It just makes all the sense in the world that this is going to be the kind of area that the market A attempts and B bounces from. Clean chart, just for you to get perspective. This is that area. So if you miss the whole rally from November of 2023, this is the kind of area that you are going to be buying. And it's also the area that is times 15, times 16 forward earnings, which are coming down. But the likelihood of you having forward earnings at 15 and lower earnings and buying that level are just not good, because the bond move makes the forward earnings too cheap in that case. So this kind of level is the kind of level that I would expect big bounces from and a lot of volatility from, i.e. up, down, churn. I just don't see the value in the market before this kind of level. And it might overshoot, but you're talking something in the 4500s to 4600s, that is where you are looking for the market to have value for you. And what can you do apart from buy value and stick around with it? VIX. Now, this never happened, okay, so don't forget about these prints up here. But if you look at a longer term weekly chart, you can see that every time it goes above this 30 level, it tends to do quite stupid things. And every time it goes above 38 to 40, it tends to do really stupid things, i.e. go up into the 60s and 70s. You really can't discount that it will do that kind of thing like it did in COVID. I don't think this is anything like COVID. This is man-made and can be fixed, or it gets fixed by price level. I think once you get the market cheap enough, right, everybody will want it. Recession or no recession, the US hasn't changed fundamentally. It's not a basket case all of a sudden and Trump terms end and policies change. And Congress can, once he sees the results, he can change his policy, or Congress can change it for him, or the Senate. All sorts of things can happen. And that is why I don't think that this is anything like COVID or anything, as bad as COVID, because COVID could have been the end of humanity kind of thing. That's what they were talking about. I never believed it, and that is why I bought the shit out of it. But the same thing applies now. When it gets to levels that are cheap fundamentally on multiples, you have to shut your eyes and buy it. Nikkei, where is cheap in Nikkei? Where I guess somewhere between 30,400 and 29,400. That is where there is value. It'll be below the monthly Bollingers, and it'll be just above that range where it spent the whole of 2022, which really coincides with what I showed you in ES, right? Or rather SPX. That kind of level where it spent a long time before it broke out. To me, that looks like value down there. If we have a look, on the other hand, at stocks, where is value in the stocks? Well, I guess it's somewhere down here where the 200-week moving average is, somewhere between 44.30 and 43.80. That looks like value to me. If you look on the monthly chart, where is value? Well, I guess, again, these levels, 43.60s, something like that. That makes perfect sense to me. Europe is, it's going to take all these people out, I'm sure. We've never really traded below 47.15 for months and months and months, and it's going to take them all out and come down to 43.66, and that for the time being probably looks enough. So message of the week is the yield curves have to get steeper, especially at the very short end, because whatever happens, the Fed is going to be hugely behind the curve, because now it's doing nothing and it wants to do nothing. So steepeners are the only things which make fundamental sense. Be patient, you will get some wonderful levels because people have to throw the baby out with the bathwater. I will tweet you when I see something important, but in the meantime, all you have to do is be patient and look for really good steepener opportunities. Remain long of the very short end, 2s and 5s. They're not going to go much against you, whatever you do. And SPX, I think the first really important level is 47.64. That's the first support that I can see. I think we will trade it, if not next week, the week after. There's very little likelihood that the market now responds to data, because all the data you're getting at the moment is in the rearview mirror. We had on April the 3rd, 2nd, or whatever it was, on Wednesday, we had a complete watershed moment. Nothing that happened before matters for what happens after it, and therefore forget about waiting for data and looking for data. The market is completely going to ignore all data that applies to before and look through it. Have a wonderful weekend. I will tweet you on Monday. It's going to be another exciting week.